Hi everyone. A lot of talk lately about silver possibly outrunning gold in this next phase, not because gold is weak, but because silver may be sitting in a much tighter setup than most people realize. So in this video, we're going to separate the real argument from the hype, and you are going to walk away with a cleaner understanding of what is actually happening in metals, bonds, oil, and the broader market. Today is Thursday, April 30th in New York. So before we get into the details, comment what day and date you're watching from, because I always like seeing where this audience is checking in from. And if you value this kind of work, subscribe and comment John A.G. Best. That lets me know you're here for the analysis, not just the noise. So the main claim is pretty simple. Silver has had a wild move, gold has stayed strong, and the question now is whether silver is just catching its breath or whether the entire story has already played out. And on the surface, I get why people are confused. Silver ran hard, pulled back hard, and now everybody has a theory. Some people say the move is finished. Some people say the paper market is cornered. Some people say the next target is so high that it almost sounds ridiculous. But the truth is probably more interesting than any of those simple answers. Let's start with the thing that actually matters. Silver is not just a chart. It is not just a metal people stack in tubes. It is also an industrial input, a monetary hedge, a trading vehicle, and sometimes, honestly, an emotional roller coaster. So if you analyze it like a normal asset, you're already missing part of the story. If you're a short-term trader, silver is dangerous. It can move against you fast, and it can do it without asking permission. But if you're a long-term investor thinking in years, not days, then the conversation becomes very different. Now you're asking whether the world needs more silver than it is easily producing, and whether inventories can keep absorbing that pressure. Based on recently published numbers, the silver market is still expected to remain in deficit this year, even though industrial demand is not perfect and some categories are cooling. That's important. Because a deficit in a weak industrial patch tells you the market is not exactly swimming in extra metal. However, and this is where we have to be careful, a deficit does not mean instant explosion. People hear deficit and they imagine the vault doors flying open, trucks backing up, and the price doubling before lunch. That's not how markets usually work. A deficit can be absorbed through inventories, recycling, substitution, lower demand, higher prices, or financial tricks. So the question is not whether the market is tight for 1 week. The question is whether the tightness is becoming structural. And that's where silver gets interesting. A large share of silver supply comes as a byproduct from mining other metals. So even if silver prices rise, producers can't simply decide to mine dramatically more silver overnight. The supply response is slower. It is tied to copper, lead, zinc, gold, permitting, energy costs, labor, and capital budgets. So when demand surprises to the upside, supply may not answer quickly. On the demand side, silver is being pulled in several directions. Solar demand has been strong, but producers are trying to use less silver per panel. Electronics and grid demand remain important. Defense uses matter. Data centers and AI infrastructure indirectly matter because power systems and electrical components matter. So demand is not a single clean story. It is messy. But messy does not mean bearish. Now, what about gold? Gold is the cleaner asset. Gold is less about factories and more about confidence. It is central banks, savings, reserves, fear, currency debasement, and trust. So when people ask whether silver can outperform gold, the answer is yes, but not because silver is safer. It's because silver is usually more violent. Gold can climb a staircase. Silver tends to sprint, trip, scare everybody, then sprint again. That is why silver breaks so many investors emotionally. They buy it for the big upside. But then they discover that the big upside comes with huge drawdowns, fake-outs, and long periods where it feels like nothing is working. So if you want silver's upside, you have to accept silver's personality. Now there is also a lot of talk about the paper market. Open interest, registered metal, delivery pressure, lease rates, backwardation, cash settlement risk, all of it. And some of that concern is legitimate. When paper claims are large relative to immediately available metal, stress can show up, lease rates can jump, spreads can behave strangely, delivery activity can get attention, but we need to avoid the lazy version of that argument. A delivery notice does not always mean silver physically leaves the building. Often it means ownership of a warehouse receipt changes hands. The bars may stay exactly where they are. So when people say, look at all the deliveries, the better question is, are inventories actually leaving? Are lease rates staying elevated? Are spreads tightening? And are buyers demanding real metal instead of just exposure? That's the difference between noise and signal. And this is also where I would push back on the most dramatic claims. Every silver sell-off is not automatically proof of a secret rescue operation. Sometimes margins rise because volatility rises. Sometimes leverage gets flushed because too many people crowded into the same trade. Sometimes late buyers chase a move and then get punished. So yes, the paper structure can distort the market. But not every red candle needs a conspiracy to explain it. The stronger argument is simpler. Silver is a relatively small market with a real physical tightness story, a lot of leverage around it, and investors who tend to arrive late. That combination creates brutal volatility, so if silver corrects after a huge move, that does not kill the bull case. It may simply reset it. Now, let's connect this to gold and war, because this is where people have also been confused. Gold is supposed to like chaos, right? So when the Middle East becomes unstable, people expect gold to go straight up. And when it doesn't, they assume the thesis failed. But during liquidity stress, gold can be sold because it is liquid. Countries, funds, and traders may sell what they can, not what they want to. If oil prices jump and import bills rise, somebody may need dollars. If leveraged funds get hit, they may sell profitable gold positions to cover losses elsewhere. If stop losses trigger, machines don't debate philosophy. They sell. So gold can fall or stall during the early phase of a crisis and still remain a long-term winner. That has happened before. In panics, good assets often get sold first because they are the assets with bids. The bigger issue is oil. From recent energy market updates, the Strait of Hormuz remains one of the most important energy choke points in the world, with roughly a fifth of global petroleum liquids and a large share of LNG trade connected to that route. If that lane is disrupted, the problem does not stay in oil charts. It moves into shipping, fertilizer, food, plastics, electricity, insurance, and inflation expectations. And here's the problem. The central bank can raise rates to slow demand, but it cannot print tankers. It cannot create diesel. It cannot reopen a shipping lane with a policy statement. So energy inflation is a different animal. It hits the real economy first and the financial economy second. That leads directly to bonds. The bond market is the part people ignore until it starts ignoring them. Stocks get the headlines, but yields are the pressure gauge. When the 10-year Treasury moves into the mid-4% area, it affects mortgages, corporate borrowing, credit cards, car loans, bank portfolios, and government interest costs. And with federal deficits still projected near very large levels, higher rates are not just a market detail. They become a budget problem. According to the latest publicly available projections, deficits remain elevated for years. Debt keeps rising relative to the economy, and interest costs are one of the forces driving the pressure. So when yields rise, the system feels it. This is why I don't like the simple bullish stock market argument that says, well, indexes are near highs, so everything must be fine. That's not analysis. That's price worship. Markets can rise while risks build underneath. They can rise because of passive flows, AI excitement, buybacks, liquidity expectations, and the belief that the central bank will always step in. And to be fair, that belief has worked many times. Since the financial crisis, investors have been trained to buy weakness because weakness eventually brought easier policy. Lower rates, balance sheet expansion, emergency facilities, liquidity windows, whatever form it takes, the market learned the lesson. Trouble often gets met with support. But here's the twist. If inflation is being pushed by oil, supply chains, and war risk, the rescue gets harder. The central bank may want to help markets, but it also has to protect the currency and inflation credibility. So the old playbook still exists, but it may not work as cleanly. Now add private credit. This is not the part of the market most retail investors follow, but it matters. From recent market updates, regulators and analysts have been paying closer attention to private credit exposure, redemptions, troubled loans, and the possibility that stress there could spill into the wider system. That does not mean a crisis is guaranteed, but it means the calm surface deserves inspection. Private credit can look stable because prices don't move every second like public stocks. But if assets are illiquid, the quiet pricing can become a problem when people suddenly want cash. We have seen versions of this movie before. The packaging changes, the acronyms change, the sales pitch changes, but the core issue is always the same. Liquidity feels abundant until everyone needs it at once. And there's another layer here that people skip. Higher yields do not only hurt borrowers today, they also change behavior tomorrow. Companies delay projects, households delay purchases, banks tighten standards, investors demand more compensation for risk. So the same yield move that looks small on a screen can slowly travel through the economy like a tightening belt. You may not notice it on day one, but after enough months, somebody starts running out of air. This is why the timing is so tricky. A bond market problem rarely announces itself with a bell. First, there is discomfort. Then there are explanations. Then somebody says the issue is contained. Then funding costs rise again, and suddenly the market realizes the boring part of finance was actually the foundation under everything. The same lesson applies to energy. If a choke point is threatened for a day, traders react. If it is threatened for months, businesses adjust. Insurance goes up. Routes change. Inventories get rebuilt differently. Governments start protecting supplies. And every one of those adjustments has a cost. It may not show up all at once, but it shows up. So when we talk about silver and gold, we are not talking in isolation. We're talking about metals inside a world where the cost of money, the cost of energy, and confidence in paper promises are all being tested at the same time. And that's the part that makes this setup different. It is not one headline. It is not one chart. It is several pressure points lining up, slowly, then suddenly. That is exactly when markets can feel calm on Monday and completely different by Friday, and nobody should pretend otherwise. Not in this market. So where does that leave metals? It leaves gold as the steadier preservation asset and silver as the higher beta catch-up asset. Gold protects purchasing power. Silver can amplify a metals bull market if investment demand wakes up while physical supply remains constrained. But the risk profile is different. Gold may help you sleep. Silver may keep you checking the screen. And that's okay, as long as you know what you own. If silver outpaces gold, it probably won't do it politely. It will likely happen in bursts. The gold-silver ratio may compress quickly, sentiment may flip from hopeless to euphoric, and people who ignored silver for months may suddenly chase it all at once. That's how silver works. It frustrates first, then surprises. But if you're successful, share your success story in the comments so others can stay motivated. Seriously, those comments help people who are still learning stay patient through volatility. Now, I want to be clear about something. Preparation is not panic. It does not mean selling everything and hiding. It means asking what happens if the assumptions behind your portfolio are wrong. What if rates stay higher longer? What if oil remains expensive? What if deficits keep widening? What if liquidity support comes back, but the currency pays the price? Those are not crazy questions anymore. And the answer does not have to be extreme. Maybe it means holding some gold. Maybe it means owning some silver with money you can leave alone. Maybe it means reducing leverage. Maybe it means keeping dry powder. Maybe it means not chasing expensive stocks just because everybody else is excited. The point is to have a plan before the headline hits. So putting this all together, silver's case is not just about a giant price target. It is about a market where supply is slow, demand is complicated, inventories matter, and paper exposure can create stress. Gold's case is not just about fear. It is about trust, currency weakness, and the long-term cost of too much debt. The bond market is not boring. It is the warning system. And oil is not just a commodity. It is the input that touches almost everything. That's why I think silver can outpace gold in the right phase, but I would not confuse higher upside with lower risk. Silver is the asset that can make you look brilliant and impatient in the same month. So here's the question. Do you think silver is setting up for a real catch-up move, or do you think gold remains the better core asset because it carries less emotional damage? Drop your view in the comments, because this debate is actually useful. Subscribe if this helped you see the setup more clearly. And just to be clear, this is education and market commentary only. I'm not telling you what to buy, sell, or hold. Your own time horizon, cash needs, taxes, and risk tolerance matter more than any video. Do your own research, think independently, and make decisions that you can actually live with when the market gets uncomfortable.